So you want to start investing. You've seen headlines like,
"Stock market crash ahead, 3 investments you need to make yourself a millionaire."
but you don't know how to start. Don't worry, that's where I come in. For the past few months, I've been learning lots and lots about different investments, and I'm going to share with you some tips that I wish I'd known before I started. This video is not financial advice, but it's more to give you some information to help you know what investing is, why you should invest, the strategies that you can use, and how to get started. With all that being said, let's get into it. Hello and welcome back to Max Talks, where every Sunday I make videos to help you get to where you want to be. For today's video, before we start getting into investing, I think it's important that we define what investing is and how it's different from trading, because these two terms are often used interchangeably. Investing is putting money into something with the expectation of achieving a profit in the long term, whereas trading is more your stereotypical stock market with what you imagine in the 80s with people shouting, buy now, the price is low. But we're not going to talk about trading, we're here to talk about investing today and the long term. So let's get started. What can you actually invest in? The first thing is stocks. This is a small part of ownership of a publicly traded company. And when you're investing, you might see some small letters next to each company. This is called a ticker symbol and basically helps you to find what you're investing in easier. So if you wanted to invest in Apple, for example, you could literally type in AAPL and you would find the Apple stocks. Simple as that. The next thing you can invest in is bonds. This is a loan given by an investor to a borrower in order to use that money for some sort of monetary purpose. And in return, these loans are normally secured and have a fixed term, so they end on a certain date. The most common form of bonds is a government bond, and as these are backed by governments, generally they're more stable and secure over the long term. A mutual fund. This is a pool of stocks, securities, and bonds which are invested in by an investment manager. So this investment manager makes the decisions on which things make up the portfolio. The whole aim of a mutual fund is that they beat the market. So they try and beat the percentage returns that the stock market gets day to day. As a result though, quite a lot of these mutual funds are actively managed. This just means that the investment manager spends a lot of their time dedicated to doing research and finding out what is best to have in the portfolio. You might think this sounds very appealing, and obviously it has its benefits, but because it's actively managed, it can mean that you pay more because you pay for the time of that individual. The next thing is exchange traded funds, or ETFs for short. So these are groups of stocks, bonds and shares which essentially aim to mimic the market. So these, rather than mutual funds where they try to beat the market, they try to match what the market is doing. And you can get certain ones for different industries or geographical locations, or even ones that track a financial index, which I will come to in a minute. So you could get an ETF for the oil industry, where it will be a pool of all of the different oil companies all in one sector, and you can invest in that ETF and get a small portion of all of those companies within that industry. One of the things with ETFs is that most of them are passively managed, which essentially means that the decisions of what makes up that ETF are made by a computer. But don't be alarmed by this, computers aren't taking over the world, we're not going to get robbed by robots or anything like that. It's actually surprisingly common, and a lot of the decisions made in the stock market are actually made entirely by computers. So don't be too concerned about that. It's not anything massive, and actually it can be a benefit because it means that the costs are lower because you don't have to pay for someone's time in managing that every single day. So the next one is index funds. This is a type of ETF or a type of mutual fund which aims to track a financial index. So to explain what a financial index is, I'll give you some examples. So one financial index, and the most popular one, is the S&P 500. This is essentially the 500 biggest companies in America on their stock exchange. And for the UK, the biggest one would be the FTSE 100, which is the 100 biggest companies that make up the UK stock exchange. So the index fund is essentially a small share of all of those different companies. The aim of the index fund is to track the performance of that index. So the index being the S&P 500. And then we also have a blended fund. So this is essentially a combination of different funds which allow you to get diversification. So it could be comprised of lots of different ETFs across different sectors, across different geographical regions, and across different industries and countries. So this could be a great way of achieving diversification without having the risk of investing in lots of different ones at a time. You can just invest in one blended fund, and then that will cover you across all of that. So obviously there's a lot more things that I could have mentioned, but I wanted to keep it simple so that you guys have something clear which you can refer to. And at this stage, before we get into like the strategies and how you can actually invest, I think it's important to throw it over to you. What are your investment goals? Why do you want to invest? Are you hoping to save for retirement? Are you hoping to get a bit of money on the side? It's completely up to you. And every individual circumstance will be different. So assess your goals before you start investing, and make sure that you stick around to the end of this video where I will go through some full other considerations that you should think about before you start investing. So what are the different types of investing strategies that you can use? Well, of course there's loads of different ones, but I'm going to cover 4 very beginner, simple ones to understand that will hopefully make sense to you. So the first one is the one that I do personally, and this is long-term index fund investing and dollar cost averaging. So essentially this just means investing a certain amount per month over a number of years into an index fund. So as I mentioned earlier, the S&P 500 has on average risen by 8% every year. If you're investing, say, £200 per month, say after your salary comes in, then over time you might buy at the highest point of the index, and sometimes you might buy at the lowest point of the index, but normally it'll be kind of in between. But if you invest over time, then your overall amount is going to grow by 8% on average year by year. The next one is growth investing. So this is where you pick out a few companies that you think have the potential to grow in the long term. Maybe they have a big competitive advantage, or maybe they're completely front runners in their field. But for this, obviously you have to do a lot of research and you have to understand what you're investing in. And I think that's one of the most important things here, is before you start investing, make sure that you understand what it is that you're investing in. The third one is dividend investing. This is really, really popular on YouTube, and you'll find thousands of videos about dividend investing on YouTube. So just to put it simply, a dividend is a small percentage of the company's profits which they give out to shareholders. And the whole point of this strategy is that you invest in so many companies and you have such a large investment that all of the money that you get annually from dividends is enough to live on in the long term. And number 4 is value investing. So this is possibly one of the most famous investing types. And if you've ever done any form of research about investing, you've probably heard of Warren Buffett. He's one of the most famous investors, and this is the strategy that he used to get his billions and billions and billions. So value investing is essentially like when you go to the supermarket and you see 2 for 1 on your favorite item of food. You look for the bargains and then you buy the bargains with the hope that you get the benefit from it. In this case, over the long term, the stock price rises and you get that profit. That's essentially how value investing works. Obviously with this, again, you have to do quite a bit of research to figure out what a normal price is worth, whether you think the price is going to rise over the long term. So that's one disadvantage, but if you're willing to put in the time, you can reap huge rewards from that. So how do you get started into investing? Most videos that you see about investing will talk about Robinhood or Webull, but upon doing research, these platforms at the moment are only available in the US and they are not available in the UK, so you can't use those. And definitely, if you're looking for investment advice, steer clear of Wall Street bets on Reddit. You'll see some craziness on there. So if you want to see some really terrible trades or just, I don't know, some absolute madness on stocks and investing, go over there, but definitely don't take financial advice from there. So first of all, I would say definitely open up a stocks and shares ISA. This allows you to put in £20,000 of money every single year, tax-free, so you don't get any tax on it. If you have more than £20,000 to invest in 1 year, then just make sure that you're aware of the capital gains tax. This essentially means that anything that's not in an ISA and that you're getting income from, if you earn £12,300 over the year in terms of growth, then you would be eligible to be taxed on that. In terms of choosing the right platform for you, I would go to a website called brokerchooser.com, and I'll leave a link to the description. It's not sponsored or anything like that, but I found that quite a useful tool to compare and contrast the different platforms and to find one which is right for you. So it allows you to put in what sort of thing that you're looking for, and it will help to align the platform with your financial goals and what you're looking to invest in. One thing that's not mentioned on there is Vanguard. So on the Vanguard website, that's really good if you want a low cost investment platform, but there's a couple of articles which I'll leave in the description which have a bit more information about that. I personally use Vanguard to invest in the life strategy fund, and there's a retirement fund as well as a variety of ETFs. The only disadvantage with that is that you can only invest in Vanguard funds, and so it kind of limits what you can invest in. Whereas if you want to kind of invest in individual companies and you want to go into dividend, value or growth investing, then maybe it would be better looking into some alternatives like Trading 212 or Free Trade or any of the other different investment platforms. So what other things should you consider before you invest? 1, don't risk more than you are willing to lose. That sounds very simple, but it can be easy to say, oh, I'm going to buy into the dip because I know that long term it's going to grow by 20% or something like that. But make sure that you're only investing what you can afford to. Consider the costs of each method. So whether you're looking at commission or whether you're looking at annual fees, because this will eat into your profits, even only marginally. But these are things to consider before you start investing and before you pick your platform. Sometimes you will even have a fee for transferring from one provider to another. So make sure that you check that out, and it will all be in the terms and conditions on that particular platform. So look at the risk factor for each investment and match this with your own risk appetite. So they call it risk appetite. It's nothing to do with food. It's basically how much risk that you're willing to take on. So most funds and most investments will have, if it is like a ETF or if it is like a mutual fund, they will have a level of risk, and you'll be able to see where it is on that scale. So if you're looking for really, really long term, then you're more likely to be able to take on a lot of risk because you have time to recover. Whereas if you're kind of wanting to invest over the kind of medium term, so maybe 15 years or so, then you may be able to take a medium risk. And equally, if you're kind of looking to invest over a shorter time, maybe 5 to 10 years, you might want to take some quite low risk investments. So do your own research. I think that's very important. Make sure that you understand what you're investing in and why you're investing in it. There is a load of different articles and news that tries to scare people into thinking, buy this stock now, or sell now, it's going to crash or it's going to rise. There's some terms, a bull market, which is basically means that the market is going to rise, and a bear market, which means that it's going to crash. Do your research, keep yourself informed, and make sure that you're happy with your own investment decisions. Don't necessarily base it off anyone else, off analysts. Definitely don't go off Wall Street bets or the Motley Fool or anything like that. Make your own decisions. So another one is how much time you can actually put into your investments. If you don't have the time to commit to the research, then it might be better that you kind of look at an ETF or a blended fund. And finally, diversify your investments. You don't want to be all in one company or all in one industry in case something huge happens, like that huge illness that's been going around recently. A lot of different industries, hospitality and airlines, it's sent their stock prices plummeting. And if all of your assets were in those two industries, then you're not going to do very well. And so that's why it's important to be diversified across a lot of different industries, but also to understand exactly what you're investing in. So, in this video, we've covered what investing is, how it's different from trading, what platforms you can use to get started, the important things to consider before you invest, and the potential strategies that you can use. Thank you very much for watching. I hope that you enjoyed and I hope you found it useful. If you did, leave a like rating, leave a subscribe below for new content every single Sunday. Leave a comment with what you think you might invest in or what strategy you might use, and I will see you next Sunday.